These low-priced ETFs are all under $100 with some slated to double within a year or two, and with one that has a dividend yield of over 16%. I'm going to go over 8 of the best cheap ETFs that I've found, and some of them are actually good substitutes to put into my 3-fund portfolio that I talk a lot about on this channel. I still believe that's the strongest and simplest portfolio out there, and everyone knows the 3 I talk about, which are VU, SCHD, and QQQM, but I found 3 funds that are very similar and cheaper, so you're going to want to pay attention for that. And for this video, I wanted to find a bunch of different types of ETFs, like ones for growth and ones for dividends and ones for safety even. And then also to diversify with some small cap. And then of course I had to hit that AI ETF as well. And real quick, while I've done a bunch of hours of research for this video specifically, I may have left out 1 or 2 that you really like. So if you have a good cheap ETF that you like, throw it down in the comment section so that I can research it and maybe make another video down the road. Now the first one on my list here is one that I've covered before, but it is an awesome ETF and I really want to share why. It's an ETF with a very unique strategy and it tracks the Russell 1000, the top 100 companies based on free cash flow yield, which means that it holds very safe and strong companies with a very low volatility rate. This ETF is called COWS, C-O-W-Z, and it's the Pacer US Cash Cows ETF. All of these companies have a bunch of cash, and the ability to generate a high free cash flow yield indicates a company is producing more cash than it needs to run the business and can invest in growth opportunity. The current price is $54. The dividend yield is a bit above 2%. PE ratio is only 11.77, which puts these companies at a super value since that PE is so low. It's also so safe because it caps each holding at less than 2% and rebalances each quarter to keep it that way. So no one holding overtakes the fund. Usually with such safety in an ETF, the price appreciation isn't very good. But this one has a 5-year average appreciation of over 17% per year. Year to date, it's up about 3.5%. It does have a fee of 0.49, and the top 10 companies within the fund are ones like Vistra, HP, Altria, Exxon, and Chevron. Solid price appreciation, a nice little dividend, and a very solid strategy. I really like this fund a lot. Now for this video, I wanted to give you highlights of my research because it took many hours of research to condense this down into something that's going to actually make sense for you. And so I wanted to introduce the sponsor of this video, Shortform, because they do basically the exact same thing except for books. Shortform is the best way to learn ideas from all those books you've always wanted to read. Shortform also makes guides to important topics you should know, like inflation in the economy and what's happening with Bitcoin. Check out the link down in my description for a free trial and a 20% discount. The next one on this list is another dividend player, but not your average dividend ETF. This one has a dividend yield over 16%. And this one's called TIME, T-I-M-E, which is the Clockwise Core Equity and Innovation ETF. This fund is so awesome because its whole strategy is that it invests in companies that are literally meant to save people time. In my entrepreneurship courses at the university, I teach students that if they can build out a business that's literally going to give people more convenience and help them just to have more time in their day, that's going to be a very successful business. All these companies are very heavy in innovation and AI, so this is a solid AI style ETF, as you can see in the top holdings with companies like Nvidia, Advanced Micro Devices, Spotify, and Ecolab. But one thing that I really like about this one is that it's actually much different than any of those really big growth-heavy funds, because this has a 10% holding of T-bills, which actually makes the fund much safer and creates a guaranteed return. They also write covered calls, and because of that, this fund has a crazy 16.39% dividend yield. It has a current price of $26.94 with a crazy year to date of up over 30% in 2024 so far. This fund is very cool and it has so much upside, But I do need to point out a couple of red flags. First is the expense ratio at 1.0%, and next is the incredible low trading volume. This fund is becoming more and more popular, so I expect that to rise, but for now, that's definitely something that should be a little bit of a risk. The last red flag is that it hasn't been around very long, since most holdings are very innovative, but for the time that it has been around, it's been on fire with a 1-year return of over 45%. Along with that crazy dividend, this fund has been a unicorn in that it has been appreciating like crazy as well. And I'm excited to see where this one goes, but I'm a little bit cautious because that dividend I don't think is very sustainable, but if it is, that would be amazing. So that last ETF was all about growth, but this next one is all about stability and safety in the energy sector. Energy investments can help you be more flexible, support growth, and protect you from market volatility. This one's called XLE, and it has a current price of $88.04. It has a very low expense ratio of only 0.09%. It has 22 total holdings, including companies like Exxon, Chevron, Valero, and OXY, which is one that Warren Buffett just made a very heavy investment into recently. XLE has been around for almost 20 years, and the average return per year has been over 8%. And the return over this last year is over 25%. Energy is definitely a very sustainable add to your portfolio, especially in uncertain times, which a lot of people think that a recession might be coming, so this might just be a nice solid defensive safety play. Especially for those of you that love Nvidia and understand that semiconductors are definitely going to be a thing in the next 5 or 10 years, but you don't want to put all your eggs in one basket and only have one of those types of companies. So this is a safer way to invest in that, but get crazy upside. This is the best semiconductor ETF that you've probably never heard of. And it's called SOXQ, and it's the Invesco PHLX Semiconductor ETF. It's $44.13, and this year alone, it's already up almost 40%. The index that it tracks has a 10-year average appreciation of a massive 26% per year. That is an insane average appreciation every single year. The fee is 0.19%, which is way cheaper than the more famous semiconductor ETF, SMH, which has a fee of almost double at 0.35%. The top holdings of SOXQ is Nvidia, Broadcom, Advanced Micro Devices, Micron, Qualcomm, and Taiwan Semiconductor. This is my favorite semiconductor fund for so many reasons. The next fund on my list is a small cap ETF, and the reason why I wanted to include that in this video is because most of the funds that I talk about on this channel are all large cap. So if you did want to diversify your portfolio a bit and have something that you're not holding in any other place, this might be a good one for you to think about. AVUV is the Avantis US Small Cap Value ETF, and it has a current price of about $87. It has a moderate expense of 0.25%. AVUV invests in a broad set of US small cap companies and is designed to increase expected returns by focusing on firms trading at what they believe are low valuations and higher profitability ratios. AVUV has 761 holdings to diversify big time. It's only been around a little over 4 years, but it has an average per year of over 8%, with the last year at over 34%. The top holdings are Abercrombie & Fitch, KB Home, Jackson Financial, Matson Inc., and Encore Wire Corp. Like I said before, this is a great fund with solid smaller companies, so it will diversify your portfolio and possibly get you some of that solid upside for more growth. Now we're gonna get into my 3-fund portfolio, but I'm gonna give you some options that are different than what I always talk about, because these will let you get in at a much smaller price point. And obviously I've made a bunch of videos on why my new 3-fund portfolio is the best portfolio possible, and I'll link to those videos after this one. But anyway, here are the 3 funds. In the 3-fund portfolio, the first category is foundational, and for that, I just love anything that tracks the S&P 500. The fund to highlight here is called SPLG. It tracks the S&P 500 the exact same way that VOO or SPY does. However, it has a very low cost price of $63.83, and it's up almost 15% this year. Not only is the share price low cost, but the fund expense is actually less than VU2 at 0.02%. Since it tracks the S&P 500, it holds about 500 companies and it's market cap weighted. With the top 10 as familiar companies we all know, like Microsoft, Apple, Nvidia, Google, and Berkshire Hathaway. The next category in this fund is dividend or value. I usually like SCHD best here, but another great option is DGRO, which is the iShares Core Dividend Growth ETF. It has a low expense ratio of 0.08%, and it offers low cost exposure to US stocks focused on dividend growth. The price is only $57.21 per share. Now, many people that don't like SCHD usually don't like it because it doesn't have great companies in it that are very fun. It has a lot of companies that are kind of underperforming the market right now, but DGRO is totally different. It still has a very nice dividend of about 2.35% with 419 companies in the fund, but of those companies, the top 10 have very fun and strong names like Apple, Microsoft, and Broadcom, but then also sustainable ones like Chevron, Johnson & Johnson, and then Procter & Gamble. DGRO has very solid performance with a 5-year average yearly appreciation at 12.29% per year, and this last year was over 19%. The dividend yield is lower than that of SCHD, but the price appreciation lately has been much higher. I definitely like this fund. And the last category is the one that's the most fun and everybody's talking about, and that's growth. I talk a lot about QQQM and SCHG on this channel, but another one that you could research is VONG, V-O-N-G, which is the Vanguard Russell 1000 Growth ETF. It has a current price of $93.54 and has an expense ratio of only 0.08%. The average appreciation on the 10-year chart is a consistent almost 16% rise on average per year. Year to date so far in 2024 is over 13%. The top holdings are ones that we're used to seeing in a fund like this, with names like Microsoft, Apple, Nvidia, Amazon, Meta, and Tesla. This is just a great growth fund with a low fee and consistent names that we're used to seeing in growth funds. When you're investing in ETFs, one of the most important things is to understand where to invest and how to invest within what type of account, like a taxable brokerage versus a Roth IRA versus your 401k. And in this video here, I go over that with the 3-fund portfolio that I just talked about. So now you'll know not only what ETFs to buy, but also where to put them. Keep investing simplified, and I'll see you on the next one.